Manipulation!
Let's talk about stock market manipulation, Moon Gang. Today is Wednesday, March 30th, but I want to dive into what happened yesterday on Tuesday when AMC and GME were both halted. Do I think something funky went on? 100%, but it's not exactly what you're most likely thinking. It's not the halt itself. The craziness is what happened right at the start of the halt. So we'll be diving into that. We're also going to be diving into the price action for both AMC and GME today and all the short interest numbers related to that. Neither of these equities had the best day, but we will be talking about some equities that had a stellar day. I'm talking about Mulan, ticker symbol MULN, and Forge Global Holdings, ticker symbol FRGE. And at the end of all that, I want to talk about one interesting trade that I'm thinking about for the overall market. So with all that being said, let's hop right into it. So we're going to be examining the stock trading halt from yesterday through the lens of GME, but just so you know, you could also generically apply it to AMC. And also a special shout out to Mr. Dave Lauer, who did this deep dive in the blog post, which will be in the description of this video. You could also find it on my Twitter. I recently retweeted it, but this is a lot of amazing information. And on top of that, I'll also put a resource about trading halts and the math behind them in a general sense. But just so you know, this one is going to be particularly through the lens of GME. The conflict of interest feedback loop, which is a new term that was coined by Mr. Lauer. So there's a lot of information in here, and I went through it in a bit more detail in today's live stream. So if you want to just find the full breakdown, go there. But what you need to know is it all comes down to, I would argue, another term that was coined by Mr. Lauer: inducements and incentives. Here is the TLDR version of this full write-up. Conflicts of interest create inducements and incentives that cause corrupt order routing practices and underinvestment in technology, both by brokers and exchanges, creating a 35 millisecond window, like pretty much the blink of an eye, during the trading halt yesterday that exposed the conflict of interest feedback loop. The alerts for options being in the money were a result of that, but did not reflect real prices. Okay. What the hell does that mean? I think I can make this a little bit more palatable for you, for me. I've read this many, many times. Here's what went down. So basically, GME, it at one point early in the morning was at 199.41. And then a little bit after that, it was at 182.79. That is a $16.6 drop, also known as an 8.3% drop in about 3 minutes. This means that according to the NBBO, the National Best Bid and Offer, in this scenario, we're talking about the bid came below the volatility line. And when I'm talking about this is, and I'll make sure that this resource is posted as well, the limit up, limit down. What you need to picture is basically they are taking in mean of the current price, and 5% above, 5% below. If you go above or below that line, which is dynamic throughout the day with the midline obviously being in the middle, that's the arithmetic mean. If you go 5% up, 5% down within 5 minutes from the current calculation, that's going to trigger a halt. It happens both to the upside, happens also to the downside. I want to make that very, very clear. So obviously here, we dropped 8.3% within 3 minutes. That was a natural trigger. That was the halt. The halt itself is not a manipulative thing. It's the craziness that happened within that first 35 seconds after the halt that probably deserves a second look. What you need to know is the SIP is a public data feed, and broadly speaking, the official record of public quotes and trades. Everyone pays a lot to get that, but they don't want it to be too good because it would naturally be self-cannibalizing, because all of these exchanges also want to sell their own private data feeds to make even more money, which is fully outlined and detailed in this write-up. Then we have to talk about some of these particular exchanges. And the one that is the star of this particular show is EdgeX, EDGX. So when we talk about payment for order flow, you're most likely thinking about brokers sending the order flow to market makers, and market makers are sending money payment for order flow. Well, similar to payment for order flow, same thing, but maybe a little bit of a different flavor, we have rebates. This is when exchanges are doing it. So think about you're trading on your brokerage and you have a limit buy order, a limit sell order. Well, those orders, if the brokerage wants, could be placed on a particular exchange such as EdgeX, and then they pay them a rebate to do it. So basically, this payment is called a rebate, and then when you do it with a market maker, it's called payment for order flow. But like I said, pretty much a different flavor of the same thing with some nuances here and there. Well, here's what happened. GME got halted. It was a limit down halt. Remember, it dropped 8.3% in 3 minutes. So that was within the 5-minute window, and it had an extreme nature to that, like really the percentage swing. So that's what triggered it. But then this is where things went awry. From the moment that it was supposed to stop trading, it's the next 35 milliseconds where things get a little bit funky. And here's what went down. They should not have been trading. No one should have been trading. When there's a halt, no one's trading. It's everyone. It's market makers. It's high frequency traders. It's retail. It's institutions. No one should be trading in a trading halt. Well, this system was a little bit slow to respond, particularly with potential up to that 35 millisecond window. Well, even though no trading was happening, remember, you're trading at a certain price. And then the reason I was talking before about EdgeX, which was getting sold the limit buys, which would be lower and lower below the current price, and then the limit sells will be above. Well, they started to clear those out. You're trading at a price. They're getting rid of the limit sales. They're getting rid of the limit buys because no one should be trading. Nothing should be happening. Well, the system did it in a little bit of a weird way, and I'm referring to EdgeX here, where they were getting out of all those limit buys. They're getting out of the limit sells. And as you can see, the bid ask is spreading as they're clearing these order by order and order. Well, some of these brokerages, Robinhood, have a really weird way of computing it. And a lot of the times they're going to be using midpoint. So basically they take the bid, they take the ask, they cut it in half, and they're like, that's where we're at. Well, all of a sudden, when you are cutting out all of the limit buys, eventually you're going to get to zero. At that point, we're trading at 182. So you're going to get all the way to zero and you're going to clear those out. But the limit sells, you can tell that there was a lot of, I guess, Redditors, memesters, apes who had really hilarious sell orders in, because at a moment in time, it was the lowest ask as they were clearing out all the other ones below it. 420.69, you had 1,420.69, 69,420.69 cents. You can tell that these were obviously people who put in comical sell orders, and for a brief moment in time, like a millisecond, it legitimately was the lowest ask as EdgeX was trying to clear all these out because the stock stopped trading. But within this 35-second window, these, like really the bid and ask, that data, these kind of quotes were being still sent to certain brokerages. Now, that is a mess up. Obviously, the SIP being a little bit slow here. There are two general possibilities. Either EdgeX queued up the release of these quotes on the other side, or the SIP took 35-second milliseconds to publish approximately 1,112 quote updates. So there could be two errors here, but I would actually go on and say there was another error of the fact that these brokerages, they were taking a stupid midpoint. In the world of coding, this is referred to as an edge case. Most of the time, they would not have to worry about this. You could easily do bid, ask, cut it in half, and that's what you're dealing with. But in this scenario, when you're using the bid and the ask of zero and a number that's getting higher and higher and higher as you're clearing out these orders because no one should be trading the stock, well, that's silly. Like, that's just, it's an edge case that they didn't code for. So this is showing and highlighting and really putting on center stage here various mess ups. You have these retail brokers such as Robinhood that have piss poor code and did not properly account for edge cases. And then on top of it, when we're talking about these exchanges such as EdgeX and SIP, well, there's a lot of conflicts of interest, and you're seeing it play out here of they don't want the system to be as strong as they possibly can in terms of SIP because they are still trying to sell private data feeds. So all of this was brought to light by the fact of this halt. The halt itself, not really manipulative. You can see all the numbers here of how is it computed. This isn't something that a human decided. It's literally called a circuit breaker. It's something that's coded into the entire market. And as soon as you violate the rules, which are like, you could easily compute these all yourself. The insanity of it is that it brought light to some of this other crazy stuff that's going on. And as Lauer would say, it really all comes back to inducements and incentives. And this time around, it was the rebates from really exchanges trying to get these limit orders from retail orders to be posted on theirs. And then it led to this with the 35 millisecond window. And obviously, that's why people were erroneously notified that their out of the money calls were in the money when they were actually never in the money because the stock had stopped trading. None of these prices were legitimate trades. It was just like the piss poor system of clearing out the limit buys and the limit sells is probably the best way we can really sum it up. But I mean, the one that I thought was interesting right here, exchanges are being subsidized by SIP money. Remember, that's the quotes and all the other information, which people are paying a lot to get on, but are failing to maintain the SIP systems, resulting in a 35 millisecond of bad quotes being published. They should have never been published because they were incentivized to keep up their own private feeds valuable in order to maximize revenue and shareholder value instead of maintaining fair and efficient markets. So that's the quick rundown. If you want more of a full rundown, I'm telling you, just watch this stream from today, but it's very, very interesting what even went down here. Once again, I'll post this in the description. Same thing with the limit up, limit down of how all this is calculated, and you can feel a little bit more comfortable about what upside or downside movement needs to occur to prompt a halt. Speaking of shitty brokerages, this is another thing that was happening yesterday, and I believe this is a brokerage that is popular in Europe, Revolut. Hi. We've seen some chatter about stock availability on our app. The info previously shared via in-app chat to some of our customers was outdated. Neither we nor our broker currently have any restrictions to trade AMC or GME stocks. Sorry for any inconvenience. You know, stop me if you've heard this before, but I'm getting really tired of these brokerages just saying, oh, it was a mess up. Thanks for pointing it out. Like, sorry, hope it didn't do anything bad to you. So I'm just giving you the update of Revolut here. I've personally never used them. I believe it's most popular in Europe, but I just wanted to give you the rundown because it's something that is intertwined with what we saw play out in both GME and AMC yesterday. Speaking of AMC and GME, AMC, not the best day, dropped almost 13%, 12.7, and then GME got pretty beat up too, dropping 7%, and then even Bed Bath & Beyond dropped 16%. Now, I want to remind everyone to stay calm, cool, and collected. Did it drop? Yeah, I mean, that's a brutal drop. But also remember where we are. In the past 2 weeks, we're still up 91%. When in doubt, zoom out. In terms of GME, yeah, that was a brutal hit. But in the past 2 weeks, we're up 113%. In the past couple update videos in reference to AMC and GME, I was articulating to the best of my ability that these types of movements are unsustainable. At a certain point, you need consolidation. And if anything, this to me, fingers crossed, we're just starting the creation of a bull flag. I'm looking for lower highs, higher lows, kind of that triangle flag structure, and then a breakup from that. Consolidation is very natural, and I would argue necessary if you want this AMC or GME to go sky high. These types of green movements, it's not sustainable. If anything, a little bit of a decline in price. I do wish it was less. Obviously, I wish it was just kind of coasting at zero, but this is what we got hit with today. But this is what the market is. I mean, we had such a huge run. It was very, I guess, almost predictable that we had to have some sort of pullback because the rocket engines were simply too hot. Now, I do want to point out one thing. So it is Wednesday, the 30th. And if you recall, 2 days ago on GME, we had a crazy day. It gained 25%. And on AMC, 2 days ago, we had a crazy day. It gained 45%. What's super interesting about this is right here. On AMC, yes, the short interest is now up to 21% in increase today. But remember, we're on a 2-day settlement system. So the shorts that could have covered 2 days ago, this is the earliest day for them to return their shares. Not many returned. 3.6 million returned, 6 million borrowed, and the shares on loan is still 137 mil with a 108 expected to actually be short. So this was a thought of mine that I was like, I don't know, like maybe some shorts covered, but I thought it was a little bit more of like in the options market, a little bit more of FOMO buying. And it turns out that's exactly what the data is suggesting to us. Not many shares were returned today. And this is important because we're on the 2-day settlement. So now we're 2 days removed from that crazy 45% jump on AMC, but utilization still 100. And in terms of GME, you're going to see the same thing. Yes, there was a net return today. There was a return of 2.24 million with a borrow of 1.27, but overall 2.24 million returned with the net change of a return of $1 million and the shares on loan still at 22.2 million, the short interest still 23%. Overall, did some cover? Yes. Was it any meaningful amount? The data is suggesting no. There's still many, many shorts betting against both of these stocks. Utilization still 100% on GME. In terms of AMC and GME, on AMC, I'm looking for support between 23.50 and 24. That's the support region I'll be watching tomorrow. And in terms of GME, I'll be watching 160 followed by roughly 151. So 160 and 150, that's what we'll call it. But remember, the RSI in both of these, it's so incredibly overextended. A break is natural. I cannot stress that enough. Now, in terms of a bit of positive development, Mulan had a crazy second half of the day, ended up gaining 29%. The CEO of the company, ticker symbol MULN, Mullen Automotive, ended up doing an interview with Benzinga, and this was a very interesting quote. "We're fairly confident that we identified enough partners to ensure that we're not going to have any delays in the builds of our products in reference to chip shortages." So this is basically those processing chips, and overall, we're just generically hearing a lot of shortages. So the fact that he was able to clarify that we're actually, it seems as if he's saying the company will not be seeing that obviously was met with a very, very bullish reaction. And now MULN is trading back at $3. And once again, probably putting some pressure on the shorts. This is one that we've been discussing because it had wonky data when it had more short exempt trades than there was even float. Now, let's talk about FRGE, another one that went crazy today, ended the day almost up 74%. I want to give you the quick rundown on this. So this is dated September 13th, 2021. Forge Global to go public in $2 billion merger with Motive Capital. Forge's mission is to create an accessible, liquid, and transparent private market. Forge operates a leading global private securities marketplace with technology that is transforming the global private market ecosystem for investors, private companies, shareholders, and employees. The best way I could describe what they do is there's a lot of companies where people have equity that's not on the public market. Well, this is a private market where that type of stuff can be traded. Obviously, it's a lot more nuanced than that, but I just want to give you kind of the lowdown on the company. Anyway, obviously, they were setting up for a SPAC deal. Last week, it went live, and obviously today, it had some crazy action. Forge Global shares soared 90%, up 306% since market debut last week. Now, if you look at the chart, there was really no fundamental catalyst that got this going. If anything, it was grinding upward, got smacked, and then started grinding again. And then out of nowhere, it exploded. I think some shorts got burned. Now, if you look at Ortex, since it started trading, it just started trading, the short interest is a bit wonky, but here's what we need to talk about. The cost to borrow, sky high. 301%, utilization 99.5. This is telling me that a lot of people try to short it, and there's still high demand to continue to short it. But what's nuts about it is the shares on loan. If the utilization is 99.5 and the shares on loan is 101, that tells me it's an extremely low float stock. And remember, the lower float a stock is, the more crazy it can actually move. And this one has a float of 700,000 shares. To kind of compare that, GME is around 75 million, and then AMC is around 513 million. This one's 700,000, absurdly low float. So really any meaningful amount of shorts could cause a huge movement. And as soon as this thing started to get going, they probably got squeezed. I don't know if it was all of them, a portion of them. I don't know what it was, but this was a low float banger that ended up gaining 74% in one day. Absolutely crazy. And now finally, to wrap this all up, one thing that I wanted to remind you of is one particular trade that I'll be watching, and this is a basic gap fill trade. The SPY has moved a lot. The overall market in the past 2 weeks is up 10%. That's a lot for the overall market. I am looking at this gap fill play from the high on March 28th, which is a high of 455.91. I think that's a layup of a play. I'm personally executing this trade through the futures market, but you could do it however you want. If you want UVXY calls, if you want SPY puts, you could do it however you want. I'm just looking at this directional movement down to the gap fill of the high from March 28th, just because I really like the statistical odds of playing gap fills on the overall market. That's what I have for you today. I would love your thoughts in a comment below. If you enjoyed this video, it would be awesome if you could help me out with the algorithm by destroying that like button. And if you haven't already, join up with the fun, join up with the channel by joining up with the Moon Gang. Hit that subscribe button. I appreciate your time. I appreciate the fact that you even spent a second of your day on this video. And I hope to have you in the next one. I hope you have an absolutely beautiful day. Peace out.